Hey guys, welcome back to another edition of what we like to call SBA Burning Questions. My name is Kyle and this is Adam from ProjectionHub. And today we have a Reddit post that we're going to look at that I'm going to read a little bit about the details and get Adam's sage wisdom on how he would advise this person. And so it's titled, How Would You Value This Small Business Acquisition? So quickly kind of go over some of the details here. So the business is around 500,000 annual revenue. You know, they got a good chunk of hard assets there, 300,000, long tenured operating history, established customer base, so that's good. Owner situation sounds like they're pretty absentee, not paying himself a formal salary. Their prices are obviously too low, 50% of market rates. Regulatory moat makes new entrants difficult. That seems pretty important. So what they're wrestling with, the cash flow is almost certainly overstated when you add back missing insurance, payroll, all of that. Seller financing, the books are a mess, and they're overpaying a couple employees. So a couple of questions. So whether you want to answer these directly or just kind of give your 2 cents on the whole situation, what multiple would you put on this? How would you weight the hard assets versus the earnings multiple? And how would you structure the actual acquisition? I guess the last question there is how much should the repricing upside factor into what you'd pay today versus what you'd capture post-close? But I think maybe in answering those first 3 questions, you might kind of knock on the 4th one there.
Yeah, this is an interesting one. So with 100,000 in stated owner cash flow, but they said here seller doesn't pay himself a formal salary. So there's out of that 500,000, there's not a payment to the seller that's going to go away and 100,000 of profit on top of it. So really all you have to play with is the 100,000. And it sounds like the way that this buyer is asking this question is that they want to like hire a manager to do this, I think, to take over whatever the seller's role is. So are you going to be able to find anybody that is going to really treat this business as if it's their own and manage it well for a total cost to the business of less than $100,000? I mean, I don't know. Maybe you find somebody that you pay a $70,000 salary, and then you've got some taxes and maybe a little bit of benefits and like at the end of that, I think you have almost no cash flow left. He also mentions like the books are a mess, so it sounds like you need to hire an accountant. There's already a bunch of costs that eat up that 100,000 in cash flow. So I think there was a question about down there at the bottom about like, would you do the asset? Would you value it based on assets or earnings multiple? I think if you look at it from an earnings multiple perspective, there's effectively no earnings. So I think you're going to get the highest valuation here based on the liquidation value essentially of the assets. I think that's what you would do. And then, why would you, if you look at the earnings multiple, let's say it's 20,000 and you give it a 3x multiple, okay, that's $60,000, but they're probably not going to sell the assets for less than that, right? So let's say you pay, what's the case here to pay $250,000 for the assets? I think that's where the repricing upside factor like comes into play, like why you would even consider paying $250 for it or whatever is because you can raise prices and increase cash flow.
And it sounds like there's a regulatory moat. So if it's protected from new competitors and it's underpriced and some employees are being overpaid, there's maybe a case to be made there. But even if that's the case, how willing do you think a lender would be to get on board with that? Or do you think that you're looking almost entirely at cash plus, well, I guess they said cash, so no earnouts. Maybe they're not even thinking about trying to finance.
Well, yeah, I mean, I'll take it from the SBA perspective since that's what I know best. I would say if the buyer is strong and let's say they have a manager ready to go, like that has experience to be able to run this, then I think a lender would effectively, treat this as it's almost like a startup, right? Like they can make a loan projection based on the projections of what it will look like when you take over. And if you're buying, particularly it says vehicles plus real estate. So if there's real estate involved, you've got a startup here that you're buying some equipment for, and oh, great news, you have like some employees lined up and some customers to call. So I think you'd almost treat it that way. Some lenders are okay looking at an acquisition that is just like an asset-based acquisition, almost treating it like a startup with projections. So
another thing that stuck out to me is we don't really know what the industry is. So hard to say maybe on a multiple. That could change a little bit based upon that. But like you said, there's really not probably that much cash flow. So there's not much cash flow at all. Then the multiple doesn't really matter because it's ultimately going to be lower than what the asset value is. But do you think, like we made a video semi recently that's kind of like the inverse side of this. If you were the seller in this situation, like maybe how would you price this if you were selling it? And just based off of their description of the details that they know, and the seller's a little informal, things are kind of all over the place, I wouldn't be shocked if this seller thinks that they're going to get to be able to sell for like the price of the assets plus some performance of the business. Like I wouldn't be surprised if the seller thinks that they can get more out of this than probably is what it's worth. And that's probably going to create some difficulty when it comes down to the negotiation of even, what price is going to be worth it.
Yeah. I mean, I think you're then going to have to, if you really want the business, then you're going to have to probably do some sort of seller note or earnout or forgivable seller note for the upside portion. Certainly don't get an SBA loan for the like upside portion. If you really like the business though and think you can, if you can double prices tomorrow and have the same amount of customers, or I guess it's not double, 50 prices are roughly 50% of market rate. Yeah. So like double. Yeah. So you could double prices, and if they're doing the same work, like most of that goes to the bottom line. I mean, that's pretty significant. So I could see why you might want to take some risk, but I would put it on the seller as like an earnout. If I'll pay you an extra 100,000 if we're able to increase revenue by X.
Also, you're depending upon how like much of a risk this is for the poster of this. Like if you're buying it based mostly off of the value of the assets, it may not be a massive risk either, right? If you have the real estate, I guess that's another part of it too. Is like, are we talking 150,000 in vehicles and 150,000 in real estate, or is it like 250,000 real estate, 50,000 in vehicles? Because if it's a lot of that's on the building and you can buy it from essentially an asset value, that could change the math quite a bit. All right. There you have it. Another, I guess this person didn't ask for SBA, but we're going to call it SBA burning question answered. If you're out there and you're kind of in a similar situation to this, where maybe you're got your eyes on a potential deal, or you're kind of trying to figure out what case makes most sense for you as you consider starting a business, buying a business, and you just like some free advice, we offer what we call a free SBA expert review. That's linked down in the description below. You can share a little bit about your scenario and get Adam's wisdom on what he'd recommend as next step. So thanks for hanging out, and like the video, and we'll see you in the next one. Thanks.